OpenDoor just nearly tripled. How a once struggling real estate tech company transformed into the hottest meme stock overnight, shocking Wall Street, and sparking serious conversations about the future of housing, investing, and what we actually consider value in today's volatile markets. OpenDoor Technologies, ticker symbol OPEN, became a financial battleground this week, igniting massive interest after shares rocketed from under $1 to over $4 in what many are now calling a perfect storm of short seller pressure, hedge fund hype, and a full-blown social media buying frenzy. This video breaks down the entire OpenDoor explosion, how it started, what's really pushing the stock up, the massive risk investors are ignoring, and whether this is the next GameStop-style short squeeze or a bubble about to burst. We'll cover the hedge fund thesis that lit the spark, how Reddit and Twitter amplified it into an inferno, and where analysts believe this stock could be headed next. So, let's start with what caused this week's insane spike. Hedge fund manager Eric Jackson from EMJ Capital publicly released a thesis calling OpenDoor a potential 100-bagger. Yes, 100x returns, noting the company's major cost-cutting moves, improving gross margins, and the real estate rebound happening in key markets. He pointed out that OpenDoor's model is finally scaling, with homes being flipped more profitably in 2024 than ever before, due to smarter pricing algorithms and decreased holding costs. That bold prediction, posted across financial circles and interview segments, was picked up immediately by Reddit's Wall Street Bets and FinTwit on X, and within hours, OpenDoor was trending on every major finance board online. Volume exploded, with over 1.8 billion shares traded, compared to the usual 100 million average, sending shares into volatility halts multiple times. Now, this isn't just random meme magic. The short interest in OpenDoor is dangerously high, well over 25% of float, which means if enough people keep buying, hedge funds betting against the stock are forced to buy back shares to cover losses, sending the stock even higher. That's the infamous short squeeze. And that's exactly what's unfolding now. But let's take a step back. What is OpenDoor? They're an iBuyer platform. Essentially, they buy homes directly from sellers, make minor improvements, and relist them for profit, all powered by machine learning. The idea is fast, frictionless home selling. In theory, this should thrive in strong housing markets, but OpenDoor nearly collapsed when interest rates surged and housing cooled. They posted billions in losses during the pandemic era and early 2023. At one point, the stock traded below 60 cents, triggering Nasdaq compliance warnings. But behind the scenes, management slashed costs, offloaded unprofitable markets, and worked to boost unit economics. Their Q1 2024 earnings showed a surprising return to positive gross margins and a narrowed loss, signaling a potential turnaround. Even more enticing to investors is their plan to reach positive EBITDA in the upcoming Q2 earnings. That projection, combined with the hedge fund backing and social media buzz, created a perfect recipe for rapid gains. But here's where it gets risky. While bullish traders see OpenDoor as the next Tesla-style disruptor, skeptics argue the core model is still flawed. The company remains unprofitable. It carries over $3.8 billion in accumulated deficits and over $2.5 billion in debt. And housing is still cooling in major US cities, which could hurt future flips. On top of that, Nasdaq is pressuring the company to regain compliance by getting its share price above $1. That's why OpenDoor is preparing a reverse stock split, possibly 1-4-20, to artificially boost its share price. That vote happens soon. If it passes, you'll own fewer shares at a higher price, usually a red flag for weak companies. And if it fails, Nasdaq could delist the stock. Meanwhile, big firms are divided. Goldman Sachs has an ultra-bearish 90 cents price target, while retail traders throw out wild $10, $40, even $100 price calls, hoping for another GameStop moment. Some see OpenDoor as a speculative trade to ride momentum. Others believe it's a fundamentally flawed business caught in a hype cycle. And then there's a third camp, those who believe the company is turning a corner and this breakout is a sign of long-term recovery. What's the smart move here? If you're an experienced trader, OpenDoor may offer short-term upside with well-managed risk. Set tight stop losses and be ready for extreme volatility. Don't bet more than you can afford to lose. If you're a long-term investor, Wait for Q2 earnings. Management must prove consistent profitability, not just a one-off margin rebound. Watch housing inventory trends, interest rates, and consumer confidence. If OpenDoor posts another strong quarter and avoids a disastrous reverse split, it could signal a genuine turnaround story. But if earnings disappoint or macro housing trends worsen, we could see this stock fall just as fast as it rose. And remember, meme stock momentum is a double-edged sword. The same community that pumped the stock this week can dump it next week. We've seen this before, with Bed Bath & Beyond, AMC, and others. So be alert, be disciplined, and most importantly, do your own research. Now, let's talk catalysts. The next big one is the Q2 earnings release, expected around early August. OpenDoor's guidance, margin details, and forward-looking statements will drive the next move. The second major catalyst is the shareholder vote on the reverse stock split. That could either restore confidence or trigger more fear, depending on how it's framed. Finally, look at the macro housing market. Mortgage rates, inventory levels, and demand trends will all impact OpenDoor's ability to flip homes profitably. If the Fed signals rate cuts later this year, OpenDoor could benefit massively. If rates stay high, profit margins will be squeezed. For now, the stock is being driven less by fundamentals and more by narrative, and that's always dangerous. But sometimes, narrative can become reality. If enough traders believe in the turnaround story and momentum keeps building, even the most beaten-down stock can rebound. That's what makes this story so fascinating. It's part data, part psychology, and part wild speculation. So what's your take? Are you buying in, watching from the sidelines, or shorting this rally? Drop your thoughts in the comments. What's your price target? $5, $10, $20? Or are you playing it safe? If this breakdown helped you understand what's happening, smash that like button right now. It tells the algorithm this video is worth sharing. Share it with a friend who's trading this week, and hit that subscribe button so you never miss a wild market move. More deep dives, honest breakdowns, and surprising financial stories are coming. So until then, trade smart, stay curious, and we'll catch you in the next one.